Hello students and welcome to the lecture. So students, as you can see here, that basically in this lecture we are going to start with the financial markets organizations, okay, and the companies. This is going to be a topic for this particular lecture, and we are going to start with the part 1 of this particular series, okay, the financial markets organizations and the companies part 1. In this lecture, basically we will go through the financial markets in India, money market instruments, certificates of deposits, like who can issue the certificate of deposits, important key points related to the certificate of deposits, because certificate of deposits, in short known as the CDS, non-convertible debentures and CDS of original or initial maturity up to 1 year, eligibility to issue NCDS, important definitions in one line, the government securities or GSEC, treasury bills also known as T-bills. Cash management bills also known as CMBS, dated G securities, types of government bonds, sovereign gold bond SGB, other important points related to the government securities, open market operations also known as OMS, liquidity adjustment facility also known as LAF, trading in GSEC, NDS-OM, and at last we will see the summary of all the topics that we will discuss. So this is going to be a very important session. Kindly pay attention over here. But before starting all of this, there is a small disclaimer that presented over here, and we are required to understand this disclaimer first. The disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, then please contact us at sathee@iitk.ac.in and we shall remove the images. So first, let's begin with the financial markets in India. Talking about this, we can say, basically the financial system in a country is generally comprises of various intermediaries who plays a crucial role in sourcing out the funds from the surplus segment and deploying such funds to the niche segment. Like you can say, basically financial market is a place where you could sell and buy like any other market, but here mainly the funds are being sold. Like you can say, suppose if there is two persons, one is Mr. X, another one is Mr. Y. Mr. X is having the access of funds, while Mr. Y do not having the access of funds. Okay. In this scenario, Mr. X will go to the financial market to sell out their funds. Mr. Y will go to the market to receive a fund from someone. They both will meet each other at the market. Mr. X will sell out the fund at some terms and conditions. Mr. Y will receive the funds on some terms and conditions. So now you can see basically it's just like the another market. Buying and selling of funds is there. From access segment which having the surplus segment and from to given to the needy segment that requires some money. The intermediaries that are there, or also we could call them as a platform for this buying and selling of the funds. These are the banks, financial institutions and mutual funds, etc. Got it? So they are responsible for it. Now, money market. The money market is actually a market for short-term financial assets that are close substitutes of money. The most important features of a money market instrument is that it is liquid and could be turned into the money quickly at low cost. Like you can say in money market, basically whatsoever short-term financial assets we purchase, These assets are close substitutes of money. These are not the money, but whenever you want to convert them into the money and whenever you want to liquidify it, it could be liquefied easily and at a very low cost so that the person who is liquefied it does not require to bear a huge amount. The call notice term money market forms an important segment of the Indian money market. Okay. Under call money market, funds are transacted on an overnight basis, and under notice money market, funds transacted for a period between 2 days and 14 days, and under the term money market, the funds are transacted for a period between 15 and 365 days. So now you can say there are the three ways of transferring the fund under the money market. First is call money market, in which on the overnight basis, the funds are transferred from access segment to the needy segment. Second one is the notice money market, in which the funds transferred between a period of 2 days to 14 days from the surplus to the needy. On the other hand, the term money market, in which the funds transacted from 15 days to 365 days on some another, you can say terms and conditions from surplus to the needy. Scheduled commercial banks, from which we exclude the RRBs, the regional rural banks. Another one is cooperative banks, other than the land development banks and the primary dealers. They all are permitted to participate in call and notice money market, and they could be participated as a borrower. It means when they need the money, as a lender, which means when they have access of the money. So they could be in all these segments. Then money market instruments. The money market instruments could be various. Commercial paper. Okay. So commercial paper, talking about this, in short, it is known as the CP. It is an unsecured money market instrument issued in the form of promissory note. The CP as a privately placed instrument introduced in India during the 1990s with a view to enable the highly rated corporate borrowers to diversify their sources of short-term borrowings and to provide an additional instrument to the investors. Then the PDS or the primary dealers and all India financial institutions, the FIs. They also permitted to issue the commercial paper or CP to enable them to meet their short-term funding requirements. Okay. So you can say the commercial papers are generally the securities that issued by the privately placed instrument instead of some authority. Okay. And these are like the person who will purchase these commercial paper, he will provide certain amount to the organization of issued. Like you can say, suppose there is XYZ company. The XYZ company launched their commercial paper in the market and they demanding rupees 10 lakh. They demanding rupees 10 lakh from it. Okay. So you can say the person who will purchase this commercial paper will give 10 lakh to the XYZ company, and in return of this, the XYZ company will give some interest rate to the person who had purchased it. After a certain period of time, which is what we call as the maturity of the commercial paper, after this period of time, the company XYZ will repurchase the commercial paper and the person will get his 10 lakh rupees in the written form. Okay. And primary dealers and all India financial institutions, they all are permitted to issue the commercial papers so that they could meet up their short-term funding requirement. Remember, commercial papers are generally the short-term funding ways. Okay, they are not a long-term areas. So now the question is, who could Like we could say, who could issue the CP? Companies, primary dealers, and financial institutions. They are permitted to raise the short-term resources through the commercial papers. Okay. Then a company would be eligible to issue CP provided first, the tangible net worth of the company as per the latest audited balance sheet is not less than 4 crores. Tangible means the visible and physical assets of the company as per their latest audited balance sheet. The amount of these must not be below than rupees 4 crores. Second, the company has been sanctioned working capital limit by banks or FIs, and the borrower account of the company is classified as the standard assets by the financing banking institution. Working capital means the money that you are required to run your company on daily basis. So that working capital must be sanctioned by the banks and the financial institutions. And because they had provided you a loan, so your loan account must be as the standard asset. Here we have seen the borrower account. It could be also the loan account. Okay. Standard assets means that you are repaying your debt timely, you are clearing your dues timely, and there is no financial and repayment conflict between you and the finance institution and the banking institution from which you had taken that money. Got it? Important key points related to the CP or the commercial papers. First, CP shall be issued in the form of promissory note. Second, CP shall be issued in the denominations of rupees 5 lakh and multiples thereof. Third, CP shall be issued at a discount to the face value as may be determined by the issuer. Fourth, CP shall be issued for maturities between the minimum 7 days and maximum up to 1 year from the date of issue. Which means the company from which the CP has been issued and to which you have provided your money within 7 days or maximum up to 1 year, they could hold your money. After that, they are required to repay your amount back to you and the dues would be clear. Okay, so this is only the tenure or what we call it as a maturity period. Now, after the commercial papers, now we have the CD, Certificate of Deposit. It is also the negotiable money market instrument and issued in dematerialized form or usance promissory note against the funds which deposited at a bank or other eligible financial institutions for some specified time period only. Okay. If we talk about the important key points related to the CDs or certificate of deposits. So minimum amount of a certificate of deposit should be rupees 1 lakh and in multiples of rupees 1 lakh thereof. So which means if you really want to purchase a certificate of deposit, so first you must give rupees 1 lakh. This is the most basic or minimum amount. After that, whatever amount you will give, that will be must in multiples of rupees 1 lakh thereafter. Maturity period of certificate of deposits issued by banks. It should not be less than 7 days and should not be more than 1 year. So we could say the maturity period of commercial papers and certificate of deposits, moreover they are same from the date of issue. Okay. The financial institutions could issue the certificate of deposits for a period not less than 1 year and exceeding 3 years from the date of issue. This is for the financial institution. Okay. For banks, it should not be less than 7 days and 1 year. The CDs may be issued at a discount on face value. What do you mean by this discount on the face value? So, we could say, suppose if the certificate of deposit was rupees 10 lakh. Okay. Then the person who is purchasing the certificate of deposit is not required to pay the 10 lakh directly. There will be some discount. For example, we are taking the discount is 10%. Okay. So the person is only required to pay rupees 9 lakh to the bank or to the financial institution from which the certificate of deposit have been issued. In return of this, after a maturity period, when that particular organization will repurchase the certificate of deposit, they will give you the entire amount of 10 lakh rupees. So the 1 lakh less which you had paid, that will be your discounted price. Okay. The banks and financial institutions should issue CDs only in dematerialized form, not against with any security. Now we have non-convertible debentures, also known as NCDs, of original or initial maturity up to 1 year. So we could say the non-convertible debentures (NCD) means a debt instrument issued by the corporate, including the NBFCs, means non-banking financial companies, with original or initial maturity up to 1 year, issued by the way of private placement. Corporate means a company which has been defined under the Companies Act 2013, even including the non-banking financial corporations or companies (NBFCs), and a corporation established by an act of any legislature in the country. Then only it could be termed as the corporate. Eligibility to issue the NCDs or non-convertible debentures. Non-convertible debentures are generally those debentures which could not be converted into the shares during the time. A corporate shall be eligible to issue the NCDs if it fulfills the following criteria. Namely, the corporate has a tangible net worth of less than 4 crores as per the latest audited balance sheet. Second, the corporate has been sanctioned working capital limit or term loan by banks or all India financial institutions. Third, the borrow account of the corporate is classified as the standard assets by the financing banks or institutions. Fourth, the NCD shall not be issued for maturities of less than 90 days from the date of issue. And at last, the NCDs may be issued in denominations with a minimum of rupees 5 lakhs face value and in multiples of rupees 1 lakh. Important definitions in one line. Call money, it actually means deals in overnight funds. Notice money means deals in funds for 2 to 14 days. Term money means deals in funds for 15 days to 1 year. Primary dealer is a financial institution which holds a valid letter of authorization as the PD issued by the Reserve Bank. Issuing and paying agency IPA means a scheduled bank acting as an IPA. CRA, credit rating agency, registered with Securities and Exchange Board of India or SEBI in short. Now the government securities, in short they are also known as GSEC. So it is actually the tradable instrument issued by the central government or the state government. To borrow the fund from the general public or from the market. That's why it's acknowledged the government's debt obligations. Like we could say, if the government had borrowed rupees 10 crores from the government security issued in the market, then the government now having the debt obligation of rupees 10 crores which they require to repay. These securities could be short-term, usually called treasury bills, with original maturities of less than 1 year, or long-term, usually called the government bonds or dated securities with original maturity of 1 year or more. GSECs carry the practical no risk of default and hence are called risk-free gilt-edged instruments. Note: in India, the central government issues both the treasury bills and the bonds or dated securities, while the state governments could only issue bonds or dated securities, which are also called as state development loans, because the state government raises this fund to run some different development projects. Now the treasury bills, in short known as the T-bills. The treasury bills or T-bills are money market instrument, not short-term debt instruments issued by the Government of India, presently issued in the three tenors, namely for 91 days, 182 days, and 364 days. These are zero coupon securities and pay no interest, issued as a discount and redeemed at a face value at maturity. The CMBs or cash management bills. In 2010, Government of India in consultation with the Reserve Bank of India introduced a short-term instrument known as the cash management bills or CMBs to meet the temporary mismatches in the cash flow of the Government of India. The CMBs having a generic character of T-bills but issued for the maturities less than 91 days only. It means these are short-term, not the long-term. The dated G-Secs. Dated G-Secs are securities carried a fixed or floating coupon, also called as interest rate, paid on the face value on half-yearly basis. Generally, the tenor of dated securities ranges from 5 years to 40 years. Notice, the Public Debt Office (PD) of the Reserve Bank of India act as the registry depository of G-Secs and deals with the issue, interest payment and repayment of principal at maturity. Then we have the types of government bonds. So basically the first type is the fixed rate bonds. These are bonds on which the coupon rate is fixed for the entire life, which means till the maturity of the bond. Floating rate bonds or FRBs, securities which do not have a fixed coupon rate, were first issued in September 1995 in India. Zero coupon bonds are the bonds with no coupon payments. Capital index bonds, bonds the principal of which is linked to an accepted index on inflation with a view to protecting the principal amount of the investor from inflation. Then, inflation index bonds, IIBs, bonds wherein both coupon flows and principal amounts protected against inflation. The inflation index used in IIBs may be wholesale price index or consumer price index. STRIPS, separate trading of registered interest and principals of security. Securities created by the way of separating the cash flows associated with the regular G-Sec, therefore each semi-annual coupon repayment and the final principal payment to be received from the issuer into the separate security, and these are essential for zero coupon bonds or ZCBs also. Then we have the sovereign gold bonds or SGB, unique instrument prices of which link to the commodity price, mostly the gold. These are denominated in multiple of grams of gold with a basic unit of 1 gram. Tenure of SGB is for a period of 8 years with exit option from 5th year to be exercised on the interest payment dates. Then, other important programs. First is the state development loans under the government securities. These are raised loans from the market which called SDLs, dated securities issued through the normal auctions similar to the auctions conducted for dated securities issued by the central government. Interest is serviced at half-yearly intervals and the principal is repaid on the maturity date. Open market operations. Market operations conducted by the Reserve Bank of India by way of sale purchase of G-Secs to form the market with an objective to adjust the rupee liquidity conditions in the market on a durable basis. When the RBI feels that there is excess liquidity in the market, resort to sale of securities, thereby sucking out the rupee liquidity. Similarly, when the liquidity conditions are tight, RBI may buy securities from the market, thereby realizing liquidity into the market. Then, what do we mean by repurchase or buyback of G-Secs? Repurchase of G-Secs is a process whereby the Government of India and the state government buy back their existing securities by redeeming them prematurely from the holders. Objective of buyback could be reduction of cost by buying back high coupon securities, reduction in number of outstanding securities, and improving the liquidity in the G-Sec market by buying back liquid-wide securities and infusion of liquidity in the system. Now we have Liquidity Adjustment Facility (LAF). Facility extended by RBI to the scheduled commercial banks and PDs to avail of liquidity in case of requirement or park access funds with RBI in case of access liquidity on an overnight basis against the collateral of G-Stacks and including the STS. Basically, the LAF enables liquidity management on a day-to-day basis. Trading in G-Stacks. Securities could be traded in secondary market either through negotiated dealing system, order matching, over-the-counter and NDS-OM web. Now we talk about the NDS-OM. In August 2005, the Reserve Bank of India introduced an anonymous screen-based order matching module called NDS-OM, order-driven electronic system, where the participants could trade anonymously by placing their orders on the system or accepting the orders already placed by the other participants. Here we have finished the topic. Now it's a part for summary. So basically we have talked about the financial system in India, like financial intermediaries, money markets, and the segment. Then commercial paper we have seen, certificates or deposits we have seen, non-convertible debentures we have seen, government securities we have seen, types of government bonds we have seen, sovereign gold bonds we have seen, state development loans we have seen, monetary operations we have seen. Okay, and with this we have finished this topic. It is requested to all of you kindly revise the facts and figures that we have discussed in this lecture and keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.